We know that when demand falls, it becomes highly likely that a recession is on or on the way. And if we only follow certain indicators, we're going to be able to determine this at a very high level. I'm going to show you some information today. Number one, that some aspects are up, some aspects are down, but what will come of it? The second thing is that demand has disappeared. I'll show you that in many categories. In fact, the third thing is debt and investments. All of these things are really happening front and center right in front of us today. If we only pay attention, we're going to see that and we could take advantage. If you stick with me throughout this video, I'm going to bring some great information. Let's begin. It's the same scenario all around the world, but in this case, food inflation climbs as Brits spend 12 billion on Christmas. So we can see that people are still spending money. It's not as if everybody's staying home, but they're spending more on what they used to just think of, something casual, something that they would consider to be, things that they took advantage of, like heating for their home. Well, now that's become extremely expensive. And thankfully, a lot of that has come down from its high, but still, we are watching people paying more for basic necessities. The UK recession will be almost as deep as that of Russia, according to economists. You're looking at this all over the place, of course. You see people in the UK spending more on basically everything. Inflation has not really calmed down at all. It's still over 10% based on the official metrics, and certainly that will impact everybody, middle class, and those below that. You look at what the average person makes, it just doesn't add up. Home prices are still, obscene in where they are in price-wise, and of course people can't live like this. Then you see on the other end of the spectrum, places like Dubai, they are spending more money than ever. They're stimulating. China right now, they're stimulating. Differences than we see with what the rest of the world is doing. And now Dubai is one of those countries, clearly, that's seeing a lot of foreign wealth coming in. 80% of the people that live there are not from there. So Dubai announces $8.7 trillion economic plan to boost trade, investment, and global hub status. We were looking at people coming from China, looking at people coming from Russia, and basically all over the world with very, very easy taxes there, no corporate taxes, no personal income taxes, all kinds of things that really attract a whole bunch of money, of course, and you get corporations to put their headquarters there, and they can take advantage of it as a result. Dubai aims to double the size of its economy in the next decade and become one of the top 3 economic cities around the world. That is I would say, a big goal, but we'll see what happens. I know a lot of people that have moved there and are certainly pleased with it financially and the economy, the safety, no crime. It's a very interesting place, and that's just showing us that, you look around and what are people after? People are, moving to Miami, moving to Florida. They're getting out of other places. California's population is declining. It's just interesting to see the dynamics of all this. Now, this article here, I just wanted to break down the fact that there's a lot going on. This article talks about FTX. It gets into what happened there. And what they say is that ultimately a digital dollar will probably occur faster as a result of this. They're going to regulate, and potentially that will lead to that digital dollar. So you could see it in here. It's out of the Hill. It's an opinion article. But essentially what they say is ultimately the collapse of the crypto company could lead to the onerous federal regulations and the establishment of a federal digital dollar. In my opinion, it will be a central bank digital currency potentially connected at some point, not necessarily at launch, but at some point with universal basic income. I think that's the way it's going to happen. This is an easy sell for people. Free money, and here you go. You get your UBI, but it's going to be attached to the central bank digital currency, and everybody's going to take it. Not everybody, but 99.9% of people, because, hey, it's free money, right? That's what's going on here. You get the inflation, you have the hard times, the difficulty. Oh, we got to keep it. We got to keep the restrictive nature here. Or they go the other way and they start inflating. Your currency is worth less. Here's $1,000 a month. People are going to say, sure, I'll take it. But as a result of that, you got to sign on to that central bank digital currency. So what's been happening in the last while is that we could see the financial conditions overall, they were loosening quite a bit from, this October timeframe of last year up until essentially the beginning of the year, mid-December, and then you looked at over the last couple of weeks, they've been tightening. There's been a lot of talk since the FOMC meeting about, actually keeping rates tighter for longer. And the markets didn't expect that. They were thinking, oh, that's it. This is all over with. It's so key to watch the cycle take place, and then you know what happens with the markets, with the economy as well. Okay, because a lot of these businesses are heavily reliant on having interest rates low. This is from the actual Fed meeting. Okay, this is what they said. A number of participants emphasized that it would be important to clearly communicate that a slowing in the pace of rate increases was not an indication of any weakening of the committee's resolve to achieve its price stability goal or a judgment that inflation was already on a persistent downward path. What does that mean? That's the Federal Reserve saying, not only are we going to continue to increase interest rates for a little while here, we're going to keep them there for a while, and we have no intention on cutting interest rates. So the market had started to price in 2023, this year, interest rate cuts. And the Federal Reserve is saying, hold your horses, buddy. We are not doing that. We'll see what happens. If a recession comes through, if you look at it historically, the Fed funds rate, usually it gets to a point, and then they keep it there for a while, and then, things are real bad, then they start cutting. So we are nowhere near that now. They're not admitting that, at least at this point. So until we get there, things are going to stay on this trajectory. Pay attention to that, because you'll see what happens throughout the economic cycle. It's the same pattern time and time again. I want to show you the next aspect here of this video. Amazon too slashed more than 18,000 jobs in escalation of cutbacks. If they are not able to get cheap debt, if Apple and if Tesla and if all these different companies are not able to access debt, and I only use these companies as an example, okay? You look at this, you see it time and time again. It's the same thing over and over. They are unable to get cheap debt. They slow down on growing. It's always going to be the same factors, just like it is in the real estate industry. Mortgage demand plunges 13.2% to the end of 2022 as interest rates head higher again. So of course people are going to say, well, if I got to borrow at such a high rate, I can't afford the mortgage anymore. So I'm going to wait it off. I'm going to wait because I was told that they'll start cutting interest rates by the end of 2023. Like I said, maybe they do, but we're not in that zone yet. So these people are going to wait. What happens when they wait? Inventory piles up. Sales drop. You start to see less construction taking place. You start to see, their buildings, they're building right now. Think about how many cranes are in your city right now, all the construction projects. And they're thinking that they have a buyer at the end of it, but maybe they don't because those people can't afford the debt. Do you see how the debt cycle works? Crazy. It's really crazy how integrated everything is. This is an indicator I love to watch, and that's the Baltic Dry Index. The Baltic Dry Index dropped at the largest we've ever seen. And that would be in this particular session. But I'm just trying to show you, this is a price change 1 day in percentage terms. Why? Because the demand has just fallen off a cliff. When you look at the shipping industry, you can ask Maersk and you can ask one of these other big shipping companies. I show you that. I show you what the CEO has to say. But then you take it a step further and you can look at a lot of the indicators, like how much stuff is moving through. And you see there aren't any more ships off of LA Long Beach. There aren't any more delays at the shipyards. They're not having this. So what does that tell you? Well, there's less demand. Demand destruction. You could see as well, I want to focus really on the right-hand side there, looking at different indexes, industrial metals, commodities, and so on. All of these have basically come off of their high. That's all I'm trying to show you. They peaked and they've come down. We'll see where that trend takes us, but this is an indication that things are slowing down. If they don't need as many of those industrial metals, well, then that slowdown appears. You see it in copper. You might see that in steel, iron ore. You see that along the way. Other factors are also there because the supply chains have eased, so no longer do you see those high prices. There's a few things happening, and we got to pay attention to that trend. If you hit subscribe, you're going to know exactly what happens with all of these different indexes, the industrial metals and so on. I look at all of this stuff. There's nobody else out there that looks into these things at this depth and continuously updates the subscribers, okay? I want to show you something. I want to talk about it here because it's going to explain what we're seeing in depth. There are a number of factors that can contribute to a recession, and one of them is high inflation coupled with high interest rates. High inflation can eat into the profits of businesses, making it difficult for them to maintain their operations and potentially leading to layoffs. Additionally, if interest rates are high, it can be more expensive for businesses to borrow money, which can also impact their ability to sustain operations. Another factor that could potentially indicate a recession is the yield curve inversion, where long-term bond yields fall below short-term bond yields. This can be a sign that investors are expecting a downturn in the economy, as they are willing to accept a lower return on their investment in the long term in exchange for the perceived safety of a shorter-term investment. Overall, if inflation remains high and companies are laying off workers while the yield curve is inverted, these could be signs that a recession is on the horizon. It's important to keep in mind that these are just a few of many of the factors that can contribute to a recession. So we pay attention to this, we look at the data and the details, and ultimately, it doesn't matter if they're willing to admit there's a recession or not. I think it's important to just know where we are at today, and that lets us prepare for ourselves and our families, okay? Let me show you this. Here are some strategies that can help you dig out of holiday debt. Why would this article be written? It's because so many people have gone into debt for the holidays. And it tells you, number one, maybe you could say that people haven't been able to have a good stance on what they do with their bills. They just don't know how to handle it. They get well into debt, they buy the flat screen TVs and all this stuff. Okay, those are the type of people on Black Friday, maybe they're rushing to go get stuff that they don't need. But in reality, a lot of people, they are just finding the basic essentials too much. And that's heartbreaking, number one, but it just gives us a little bit of insight as to what's happening for a lot of people. In fact, more than 1/3 of Americans took on holiday debt in 2022 with an average amount of $1,549. About 37% of holiday debtors said it will take them at least 5 months to pay it off. And you know, it's not going to be 5 months, it's going to be a year. They're going to carry it right through into the next year. It's just, showing us at a 19% interest rate on a credit card, 19% plus. Some are even higher. That is just not going to be paid off. And this helps MasterCard, it helps a Visa, but it doesn't help you and I, does it? So we got to watch out. We got to be careful about this. We do not want to take on high interest rate debt if we can help it. That's so important. Now, some people are looking at this and saying, well, where can I put money? Well, I'm not here to give financial advice, but some people are doing this, and this is the Series I bonds, are still a great consideration for short-term investors. So they've come down. They were, when I was talking about this initially, they were at 9.62%, and then they started paying out at 6.89%. Still much better than keeping it in any sort of other bond, as far as I'm concerned. Corporate bonds, you don't find them around this range anyway. You can look at where stocks are headed right now. The only downside in this case is that there's a maximum $10,000. So this is just something I wanted to show you because a lot of people have been really interested in this. So there it is for you, I bonds. You can look that up if you're in the United States. When we take a look at what has happened recently, we need to realize that this is all part of a cycle. If we follow that cycle, we're going to be able to take advantage of it. When the recession happens, this is a deflation. The expectation is that the Federal Reserve is going to turn on the jets and they are going to inflate away the currency. You got to hold on to real assets. You have to hold on to anything, really. And during these times, you are the one that is able to withstand all the damage. But people who are just trying so hard to make ends meet, they're going to be the ones that are punished. It's so important right now at this time to do what you can to be prepared If you found the video informative, hit that subscribe, and every single day I'm going to bring you the latest and greatest news. I'll see you tomorrow. Take care.